finding the elements that go towards what style you prefer. Gold's been a good example of this morning because this is a 15-minute chart, and the reason why it's a 15-minute chart is because we're looking for the trade on, say, a 5-minute chart. So it's always a good idea to get your process and your structures on a higher time frame and get the detail on the lower time frame. It's not a bad idea because it also gives you context to your value lines on a higher time frame as well. So when we see this context, for example, we can see that we had really this big balance area at the highs. We then gave ourselves a very, very nice balance area in there. We can see that the acceptance at lower prices never really happened. However, there was enough down here that you might have just decided to draw a new balance down in these areas. Well, that's still a sell-side distribution, isn't it? There's a nice distance between each of these sell-side distributions. So as we come up into this area, we know that we are looking for a short sell. And on the basis that we know we're looking for a short sell, we can then go from the 15 down into the 5-minute chart. And as we know we're looking for that short sell, we start looking for the trade area. We start looking for a level 2. We start hunting for the trade, and if we can't find it, we can go down into the 1-minute chart. And as we go down into the 1-minute chart, we start recognizing some key reference levels. We can see this incredibly large volume. Now, as you drill down into the lower time frame, one of the things you can do is, of course, you can use exactly the same rule base that we are using in a higher time frame to find this trade in the first place. In other words, what you can do is you can start using the same rule book at exactly the same time, except for the time frame is different. We know we want to sell this, but now we've got to try and find a seller at lower prices to sell into. So we can't sell perhaps the fade, which would be a natural trade for most people to have considered selling the fade. Now on this occasion, it turns out that it's a brilliant sell trade. You can see that for this to become a sell, we want to see a heavy seller coming in at lower prices. Now you might call this the heavy seller here, or you might wait until you see this sell side business coming in here. Realistically, I'd probably be looking to wait for that trade there. So now we've got our double distribution down with a seller at lower prices. We are in the right location on a 15-minute chart. We're in the right location on a 5-minute chart. And we now have the 1-minute chart in terms of the order flow lining up with a perfect trade narrative. Now I'm looking for selling pullbacks. 1 second. So we can see now we've got the perfect trade in the perfect location, haven't we? We've got a double distribution down on a 15-minute chart. We've got a double distribution down on a 5-minute chart. And now we've got a double distribution down on a 1-minute chart in the right location to have the double distribution down, isn't it? We've got the sellers at lower prices on a 5-minute chart. We've got sellers at lower prices on a 15-minute chart. And we've now got sellers at lower prices on a 1-minute chart. Our probability is starting to explode. Our idea about the direction is now on multiple time frames of analysis. It's not on a single time frame anymore. And we're now able to start diverging into the storyline. Come away from the big charts, come away from all the other details and start really focusing into the storyline here. And when we see this value developing into this, we can start drawing in some straight lines against any pivot price. Now, the best pivot price, if you're using Bill Williams, there was one perfect pivot right there because it had 2 to the left, 2 to the right. There's your sell. There it is, right there. That's your sell, and it turned out to be the top tick price in the last passage of play. And that might be your only trade. Literally, that might be your only trade. And if it is, you've waited all this time for that to develop because there was no double distribution down in this area here. There was no double distribution down in this area here. There was no double distribution down in that area there. And then we finally got a double distribution down. And then we got the tap back into the same area here. We got the level 2 liquidity. And then you get your sell. And that sell went from 49 to 45 for $400 so far. If that's your only sell today, are you bothered? If that's the only trade you've waited for today, do you care? Well, maybe you do, because maybe you want to trade a lot more than once a day or twice a day. In which case, of course, maybe trying to find the original trade on the 15-minute charts may be a little bit too big a chart time frame. Maybe you want to go from the 5s to the 1s to the 15s. Maybe you want to go from the 1s to the 15s to the 5-second charts if you want to do a lot of business. But the point is that all the levels stack up. The point is that when you're on the 15, you're trying to come up with an idea in the first place. And obviously on the 15, you can see that the idea is now very, very visible. The structures on these charts are incredibly visible. You can start thinking about measures are incredibly visible. Key levels are incredibly visible. You're starting to recognize the stuff that really matters on a macro chart, even though you're only on a 15-minute chart, it still is starting to give you the context for the previous day and today, which you don't see on a 1-minute chart. As we look at the US dollar in those areas, we start looking at today's business. We can see that the dollar bids is leaning on this sell side opportunity on gold. When we look at it from the silver point of view, you're starting to look in these areas and you're starting to ask the questions. Have I got any kind of snapbacks? Well, it's unlikely to see it on a 15-minute chart, and that's why you start drilling down into a 5. When you go into the 5, you can see that there was a big volume snapback trade at exactly that price. Perfect good example to do some business. When we drill down into the 1s, you can start to look in these areas and you can see that there was no snapback on that candle, and there was no snapback on this candle either, but obviously that's got a pin, so the snapback happened during that candle. And obviously that means that you might have to find it on a lower time frame reference. And there's the candle you're looking for right there, and there's the snapback, and there's the volume right there. You see it? It is so visible. Your trade is so visible, it's just ridiculous how clear it is to get that bit of business done. And the takeaway from that trade has been, as I said, pretty good. You've gone 45s from a high price of 49s for $400, and it may be your only trade of the day. And you know what? That's absolutely fine. I've got a little bit of short bond on again, by the way, guys. I don't know if anybody's been joining me again on this short bond, but we sold some 23s this time. We've got down to 16s at the moment. So that's turned out to be pretty good. In line with the Jack Ryan trade. The Jack Ryan trade, I was basically buying the black line here, so I was selling bonds into that lower low trade there. So I was selling bonds into that lower low narrative, and as I said, the Jack Ryan trade giving me a bit of profit from the 23s down to the 16s, making some monies. And relatively straightforward. Why do we call it the Jack Ryan? If anybody's seen the movie, you'll know exactly why we call it the Jack Ryan trade. It was basically the storyline behind the movie was very basic. It was about the manipulation of money to try and drive the markets into a frenzy. And the three markets that were in question were the dollar, the US Treasury bonds, and oil prices. The dollar, US Treasuries, and oil. And obviously there's an element of truth about it, in as much as obviously these markets are all connected, and therefore there is analysis to be had from these narratives, and that's why we've called it the Jack Ryan trade. And it's basically looking for any type of manipulation that we can assess on the three narratives, and that's what we're trading here, the three narratives. So we've got the oil, the bonds, and the dollar itself. And you can see that the Jack Ryan trade is buying the black line, means selling bonds. And that's what we've got at the moment. We've also got a long oil trade on at the moment as well. The long oil trade is making some really good money from 83.20, now trading 83.80. $600 since we live called that in the room this morning. And that's pretty good. That's pretty good. So Jack Ryan making you some money. And you know that we like to give trades like this names because it gives it a personal idea rather than simply a computer type game narrative. It's good to think about the Jack Ryan trade. It means people will remember it better because it has some reference that they can recall. And obviously trying to remember things seems to be the biggest challenge for most people in the room. So it's anything that helps people remind themselves. And just look at what happened to oil there, guys. We told you we had a target price of $84.20. Look at what's happening here. It's looking good, isn't it? It's looking good. We're on our way to that $84.20, guys. Woo-woo. If you took the trade, that is. I say woo-woo, but perhaps like the bonds, you never took the trade. Maybe's aye, maybe's no. Hopefully you did, guys. Hopefully you did get it. Nice trade on oil.